global ratings agency Moody's downgrading India's outlook to negative from stable has sent shockwaves through business and economy circles. Moody's has cited the possibility of economic growth remaining materially lower and a rise in debt burden as one of the primary reasons for the downgrade. The government of India has responded by saying that fundamentals of the economy remain strong with low inflation rates and low bond yields, one of the fastest growth rates in the world as well. Coincidentally, the downgrade in India's outlook comes on the third anniversary of the demonetization move that some believe has contributed to the slowdown the Indian economy now finds itself in. So what was the reasoning behind Moody's downgrade and how much does it really matter in the bigger picture? To speak on this, we have a fantastic panel of experts lined up for you, but I will start by speaking with William Foster, VP Sovereign Risk Group at Moody's Investors, joining me now from New York. William, thank you so much for speaking with us here at ET Now. Let me begin with one line from the report where you say the prospects of further reforms that would support business investments and growth at high levels and significantly broaden the narrow tax base have diminished. This is also one of the reasons cited for the downgrade. Why do you think the prospect of further reforms have diminished when we've seen a slew of announcements from the government of the day to try and pull India out of the slowdown it finds itself in?
Well, first I want to clarify that the rating itself, the Baa2 rating, has not changed. That has been affirmed. Yes. It's the outlook which has changed to negative. And really the basis for that was we're seeing a much more pronounced slowdown in growth than certainly we'd anticipated 2 years ago. Real GDP growth has fallen from about 8% 5 quarters ago to 5% today, along with nominal GDP growth, which has really come down as inflation has been contained. What the challenges that presents to India more broadly is that with lower growth, particularly lower nominal GDP growth, you have lower tax buoyancy, so your ability to collect taxes and revenues goes down, which makes it more challenging for the government to meet its fiscal deficit objectives and broader fiscal consolidation, bringing the debt to GDP ratio down. And at the same time, it makes it very difficult to create jobs and to bring the economy up to a stronger, more sustainable growth path with rising incomes. And the reason we mentioned what we had in terms of reform outlook is largely because there have been many reforms that have been passed that were very important. Those are the basis in large part for some of the positive movement we've seen over 2 years in terms of our view on the credit, GST, the Insolvency and Bankruptcy Code, the implementation of the Fiscal Responsibility and Budget Management Act. But what we have not seen is really successful implementation of those various reforms to the degree that they've had a material impact providing positive support to the economy. We may see that over the longer term, yes, but that is a challenge. And more importantly, the other reforms that we need to see, just to conclude, would be really in the factors of production. So things like labor and land reform that would really have a meaningful impact on the attractiveness of India as an investment destination and really drive growth much higher at a sustainable level moving forward. We think the prospects for those are more challenging today because the previous series of reforms have not been fully implemented.
So if I understand correctly, the concern is more with the implementation of reforms in the past, which raise questions about how further reforms, if brought on, would actually be implemented, more than the government actually going ahead with a fresh slew of reforms, because there seems to be no big challenge in terms of the will to bring in reform.
The government is clearly focused on these issues. They absolutely have moved forward with a series of important reforms over the last several years. But yes, the challenge really has been implementation, the effectiveness of the reforms once they've been passed. And that's where we're really seeing a gap between intention and outcomes. And that's really weighing on the economy right now, in addition to the challenges that you're seeing with regards to the NBFC sector and other things that are new. These implementation challenges are really weighing on the effectiveness of the intended reforms.
Does this also, tie in with another statement that's been made in the report, where you say although Moody's expects these measures to provide support to the economy, and you're referring to recent measures, they are unlikely to restore productivity and real GDP growth to previous rates. Is there also a question of implementation of reforms that have just been announced? Or is it that they're too shallow to tackle the depth of the problem?
We think at this stage of the evolution of the Indian economy, the reforms that were passed certainly need to be followed through in full, but there does need to be a next wave of important transformational reforms to really bring growth to what had been higher levels in the past. And that would be, again, tackling things like more flexible labor laws, improving or easing the access to land, better infrastructure. All of those things would improve the competitiveness, along with the tax reforms that were just passed for corporate taxes. You need to see those material changes on the factors of production to really bring the growth path higher at a sustainable rate.
The corporate tax reforms that you talk about have also raised concerns on the fiscal deficit front, isn't it? And not just the corporate tax reforms, but others as well. And, the report talks about India missing the target. Now, how big is that as a concern in the bigger picture? Because there is a point of view domestically as well that maybe the fiscal deficit targets need to be relaxed for some time to enable India to pull out of the slowdown.
Well, there's certainly trade-offs, right, in terms of the short-term impact on the fiscal deficit versus the longer-term impact on competitiveness and potentially improve revenues in the future if economic activity really picks up. So this is, you can't look at it in isolation. You have to look at it both in the near and the longer term. But I think what we've been seeing over the last few years is consistent slippage from the fiscal deficit targets. It's not just this year. It's been a consistent thing over the last few years that's really built up and strayed from the intended fiscal deficit roadmap and the targets that had been set out by the Fiscal Responsibility and Management Act.
Okay, I just want to focus on one more aspect from the report that I thought was very important and didn't get as much play is when it talks about the costs of climate change and pollution on India's outlook. I think those are some factors which are underplayed generally in the debate on what's happening with the economy. Can you elaborate on those points and the concerns there, William?
Sure. The environment is a very important consideration. Obviously, ESG, environment, social governance issues are something that we're following very closely. And in India, obviously, you see the climate risk and environmental risks are material in the sense that pollution obviously is very high. You can see that obviously in cities like Delhi. There's issues around water scarcity, water management. And over time, if these are not addressed in full, they certainly have an impact on the economy and social welfare, people's ability to contribute in full to the workforce as healthy workers. And ultimately, that starts to weigh on the economy through various channels and productivity, but also consumption and the attractiveness of India as a destination for foreign investors and for domestic investment. So those are just some of the implications if these environmental issues aren't addressed over time.
Now you've listed reasons or factors which can contribute to a downgrade in rating in the future, or an upgrade in rating in the future as well. What do you see as a timeline, William, for these factors to actually improve at the current pace, in the current situation, with the reforms that are currently on the table?
There's no set timeline. This is really something just to signal that the pressures over the last 2 years have really built up toward the negative downside. And there's certainly sufficient time for the government to address these, over the looking forward, but there's no set time horizon under which that will necessarily take place. But the challenges are clear. It's really to get growth back on track at a sustainable level and to use that higher growth to contribute to fiscal consolidation.
I must ask you about demonetization, because the year after demonetization, Moody's, of course, upgraded, India's ratings, and now we've gone and cut corporate tax rates, and there's a downgrade in outlook. There is a view that demonetization may have contributed to the current situation. Where do you stand on that?
It's a really good question. And fundamentally, one has to ask themselves in isolation, what was the impact versus the accumulation of various reforms. Our view is that demonetization was the beginning of a series of measures that ultimately have weighed on consumption. So it was demonetization followed by the GST implementation, and then ultimately what banks have been dealing with high NPLs, and then more recently the NBFCs, which have been important providers of credit, particularly to the retail segment when banks lending had slowed. So all of these things together have really had an impact, along with lower food prices, which has had an impact on the rural sector in particular, and increased farmer distress because of the negative terms of trade shock. And demonetization contributed to that, but there are many other factors that have led to where we are today.
All right. Thank you so much, William, for speaking with us today and giving us some perspective on that Moody's report, which is being cited as sort of the biggest event as we track this economic slowdown story. But is it really? How crucial is this report in the larger scheme of things? How much of an impact does it make? To speak on some of those aspects, I'm joined now by Pranav Sen, former member of the Planning Commission, and R. Sriram, resident editor at Economic Times. Welcome to both of you, and thank you for speaking with us. Mr. Sen, let me come to you. We've seen the report, we've seen the government response. We also know that all said and done, India is growing at the largest pace, as compared to the rest of the world. How much should this report worry us?
Well, frankly, this what Moody's has done is just put out a warning shot. What they've said is that there are looming dangers, and unless you do something about it, you're in imminent danger of getting downgraded. Now, this is a serious comment. A downgrade is a very serious thing. This is a warning for us. Now, the fact of the matter is, I personally think that this warning has come a little late in the day. It should have come maybe a year ago, but that it's come, I think, is not a bad thing. How will it impact us? Frankly, not very much. As a country, the sovereign rating of India really affects people's perceptions about the country. It doesn't have any real material impact upon what goes on, because anybody who's actually going to invest in India is going to do a whole lot more homework than just look at a rating report. But the point is that if India were in fact doing sovereign borrowings abroad, these kinds of ratings would make a substantial amount of difference on the yields on Indian sovereign bonds. But that's not a danger. We don't have a sovereign yield at the moment. So one should really look at it more as a cautionary sort of indication than anything which is going to make a substantive difference to the economy.
Sriram, you want to come in on the whole impact of the Moody's report? Is it more than anything else underscoring how deep the problem is?
I think yes, and I think the Honourable Professor's point is also correct, that we are also seeing these reports coming out just now around the time when the third quarter has begun, and it was expected widely that the second half will be better for the economy than the first half. While that expectation is still valid and a lot of people hold on to that expectation, we are also seeing these reports come out, that Moody's report today, and I think Nomura released another report which said that the GDP for FY20 will be less than 5% at around 4.9%, and there are some voices that indicate that the fiscal deficit is going to be breached, and breached quite substantially, and not just by a small blip or something. It's not going to be 3.3 or 3.4 or something, but it's going to be substantially higher than that. But having said that, I think we should also keep in mind as to what happened last time when the Moody's released its earnings, its sovereign upgrade for India. That was, I think, sometime in November 2017, and there was a huge wave of euphoria about how the fact that the economic success of India has actually now been recognized globally, and Moody's being the first globally recognized, credit rating agency to upgrade India. But what has happened since then has been something quite different. So a lot of decisions, that will be made about whether to invest in India or not, whether to expand in India or not, put up new projects or hire new employees and hire new workers, are going to be made based on very, very different things. They're not going to be based on ratings. They're not going to be, foreigners are not going to suddenly decide, okay, we're going to pull out all money out of India. We've already seen how the FDI figures have been for this year, despite the fact that the slowdown is now well into, well past 12 months. So I think it's something that we need to take note of. It's something that is going to make us sit up and take notice, and the government, policymakers, and everybody should read very carefully into what Moodys is saying and the possibility that what they're saying could come true. But beyond that, I don't think on the ground there is going to be such a huge negative impact.
Yeah, surely not. It's a game of perception. I want to welcome Pooja Mehra to the conversation. Pooja, I think the worrying bit is the overall point that Moodys makes, that we're not going to see an uptick soon. And this was a hope from some of the commentary coming in from IMF, etc., that this could be a pain for another 2-3 quarters. Moody seemed to suggest that's not the case.
Tamanna, in fact, I think this is also the understanding of all the economic advisors in the Prime Minister's Economic Advisory Council. And they had, in fact, cautioned the government even before the July 5th budget was presented, where they said that, unless some very well thought out and series of reforms are undertaken, growth in the next 2-3 years, will not be, 6%, 6.5%, 7%. It'll be less than that. So I'm afraid, what Moodys has said today, in fact, confirms the view of the economists, many of the economists who, in fact, work in government.
Okay, other sort of concerning points is about the faith in the ability of more reforms coming through. And this, I think, deserves a little bit of discussion. Let me come to you, Mr. Sen, on this point. And we just spoke with Moodys a couple of minutes ago, and they talk about the concerns with implementations of reforms. They gave us a thumbs up for GST, for IBC, but the question is about implementations and whether deep reforms in labour, land, etc. will come. Do you think that that's a genuine concern, looking at the fact that the government keeps talking about addressing problems sector-wise and seems to be on the ball in terms of, admitting that there is an issue?
Well, frankly, I have a little bit of a take on this which may not be that popular, which is I think Moodys made a serious error when they upgraded us in November 17. The other two, S&P and Fitch, kept us at the bottom of investment grade, and we are still there. So now what has happened is, with the subsequent developments, I think Moody has a bit of egg on its face, and they are now starting to sort of make corrections for it, and this is the first step. Eventually, I think they will fall in line with what S&P and Fitch have been doing for last several years. Now, if that happens, there's going to be a much bigger story than what we are discussing today. As far as the reforms part of it is concerned, I don't think any of us were under the impression that major reforms like GST or IBC would start working like clockwork from day one. We are always prepared to give it 3 to 5 years, because that's the kind of time it takes for institutional development to happen, to iron out glitches. So now to come in and say that, look, the implementation isn't as good as we would have liked, the reply, and I think the correct reply to that would have been, what would you have liked? These are not things which any country has implemented smoothly overnight, and we certainly aren't about to do that either. Now, is this just a face-saving device? Perhaps it is.
Okay, Pooja, let me come to you on that one. And I actually asked Moodys this question, that you upgraded us after demonetization, you're downgrading our outlook after corporate tax cuts. What's going on? And we are speaking on the 3rd anniversary of demonetization as well. Is there a broad consensus now on the link between the decision of demonetization and what we're seeing happening 3 years later in the economy?
You mean in terms of the rate cut?
In terms of the slowdown. In terms of the slowdown.
In terms of the one of the contributing factors to the slowdown was certainly is demonetization. And you recall my own story about how the corporate sector, investments in the corporate sector, came to a grinding halt in the year of the demonetization. Is one of the sort of the telling evidence of the impact demonetization had. And if this is the corporate sector, we can only imagine what happened in the informal sector. But I'm not one of those who links the slowdown solely to demonetization. I think if you look at the quarterly data, the slowdown was visible 2 quarters before the quarter in which demonetization was announced. And I think the starting point was the fact that there was a lot of stress in the financial sector. The problems of the banks and the NPAs was not resolved. The government deterred on that, and the slowdown started initially because of that. An investment slowdown had started way back in 2011-12. That remains unresolved even today. After the investment slowdown, we saw exports remaining stagnant, exports growth remaining stagnant 2014 onwards. We've seen the industrial sector now almost close to contraction zone, and therefore once the slowdown is kind of spreading from one segment of the economy to another segment of the economy, and
sure,
because of which people's incomes are affected, and now we are seeing even a consumption slowdown.
Right.
So that demonetization is definitely an aggravating factor, but slowdown started before that.
Yeah, no, absolutely important commentary on the 3rd anniversary. I'm nearly out of time, but Sriram, I want to bring focus to one point that hasn't got as much sort of light as it needs to. That along with the sovereign outlook, Moody's has also downgraded 21 companies, Indian companies, including some blue chip stellar ones, SBI, HDFC Bank, Infosys, TCS, etc. What's your take on that, Sriram? Is that what needs a little bit more focus than just the overall outlook downgrade?
Well, I don't think it will get as much focus as the outlook downgrade. Obviously, the outlook downgrade is a much bigger story, and if it's followed up with a sovereign downgrade later on, well, that of course is a hugely even bigger story. But I am just a little surprised about some of the rationale that has been given and the actions taken on those 11 institutions. Institutions like, for instance, Exim Bank, SBI, HDFC Bank have had their outlook downgraded to negative from stable, but some of the other institutions like your Canara Bank, and I think if I am not mistaken it is UCO Bank or UBI, I am not very sure about it, I don't remember it very well, they have had their outlook retained. The obvious the explanation given is that the kind of government support that would go to these institutions that is higher, and therefore Moody's has agreed to retain them at in the same level, whereas in other cases like SBI and HDFC Bank and Exim Bank and other cases there has been a downgrade in outlook, which to me is very surprising, because I would think that in case of a crisis, in case of a crunch, the government would probably do a maximum best to try and support institutions like Exim Bank and SBI,
right,
and not so much about Canara Bank and UBI. I'm not saying they're not important,
yes,
but the scale of the level is very different. So I'm just a little surprised about the actions on these things, and I think, I haven't read much in the press release that kind of really explains it in a very logical manner. But no, yeah, I don't think that these institutions, the action on these institutions would really be that significant. It is significant, of course, but the bigger story today, of course, is the rating downgrade.
Absolutely,
downgrade on outlook.
It's a signal. It's a bit of a warning sign. And as I was speaking with a top corporate name today, sometimes you need a bit of a jolt to really push yourself to make big changes, and in this case, the big reforms that the Indian economy needs. Let's wait and see what happens. Thank you so much to all of you for joining us on the show this evening. Thank you to all of you for tuning in. We'll see you back here on Monday. Good night.